Over 2 months later, Kenya has lifted the ban on the giant Somali-owned cash transfer service Dahabshiil after months of investigations into cash transfer operations in Somalia allegedly being exploited by terrorist groups like Al-Shabaab. But that inevitably leads to the original question we asked right here on this program on the 7th of April. Where's the evidence to support a ban on this scale? We'll be exploring that issue and plenty more right here on Global Business Africa. Thank you for joining us. I'm Ramah Nyang. Here's what's in the pipeline. The oil explorer Tullow opts for an out-of-court settlement of a capital gains tax dispute with Uganda. And 10 years on, a family business in Ethiopia is battling to stay afloat as international shoe firms move in. Our lead story tonight comes straight out of Kenya. The central bank has lifted the suspension on Dahabshiil's Kenyan subsidiary with immediate effect. On the 7th of April, Kenya Central Bank suspended all licensed remittance firms, ostensibly in order to curb cash flow to Al-Shabaab militants. Now, the authorities now say they have carried out a comprehensive review of Dahabshiil's Kenyan operations and policies. They now say they're satisfied that the company complies fully with the law and operates strict anti-money laundering and counter-terrorism financing procedures. Dahabshiil will also benefit from access to the Kenyan Ministry of Interior's new Integrated Population Registration Services database, which the ministry has introduced in order to facilitate local customer due diligence. The CEO of the Dahabshiil Group, Duale, has welcomed the decision to lift this ban. The Dahabshiil Group operates in 126 countries, including Kenya, the United Kingdom and the USA. Across our borders to some news out of Uganda now. Tullow Oil has agreed to settle a long-running tax dispute with the Ugandan government out of court. As Michael Baleka reports, Tullow has agreed to pay $250 million, nearly half of the original sum demanded by the government in a dispute of a capital gains tax.
Tullow, one of the major exploration companies operating in Uganda, has agreed to pay $250 million in full and final settlement of its capital gains tax. This follows discussions with the government of Uganda and the country's revenue collection body. In July 2014, Uganda ordered Tullow to pay over $400 million in taxes related to the sale of local assets to Chinese oil company Sinopec and French-owned oil company Total. But the company then sought arbitration to reduce the cost. According to a statement released today from the Irish-owned company, all legal proceedings have been dropped. The deal has earned Uganda almost half of the tax money originally demanded. In recent months, Uganda has proposed changes in its tax regime for oil and gas investments. This agreement, according to analysts, could remove a roadblock to the award of production licenses to help advance the development of the oil discoveries. Uganda discovered exploitable oil deposits along its western border with DR Congo in 2006, with estimated reserves at up to 3.5 billion barrels. Michael Baleka, CCTV, Kampala.
Now, on to wage talks between South Africa's gold firms and their 94,000 union employees. Those talks started today, but both sides are far apart. The talks involve AngloGold Ashanti, Sibanye Gold, Harmony Gold and two smaller producers. They come at a time when the sector, however, is grappling with a myriad of issues: depressed gold prices, falling output and rising input costs. The two biggest unions, that's the National Union of Mine Workers and the Association of Mine Workers and Construction Union, have both submitted wage demands ranging from 80% to over 100% for entry-level workers. Investor jitters about these talks have been underscored quite clearly on Monday. Johannesburg's gold mining index at the JSE was down by nearly 5%. Gold spot price also fell, slipping back to under $1,200 an ounce. Now, Kenya's government often touts its plans to add 2 gigawatts of geothermal generation capacity as solid proof of its green credentials. Now, what the government usually doesn't tell you is the fact that between now and 2018, the country also plans to add 1.9 gigawatts of generation capacity fired by what some will see as a very dirty C word: coal. Earlier on, I spoke to Cliff Ortega, the head of Energy and Natural Resources at Standard & Mutual. Our conversation started by me asking him if coal's environmental cost is a concern for prospective mining investors in Kenya.
even on our continent, South Africa, I think, looks to call for, close to 90% of its energy production.
Absolutely.
The United States, countries like Australia, are still huge users of coal. So the industry is looking for ways to burn coal in a cleaner way. There's so many different types of things like burying carbon and that type of thing. So what we need to do is not look to reinvent the wheel in terms of solutions, and also we need to learn from the mistakes. I think the technology today for burning coal is a lot further than it was, say, 50 or 60 years ago. But we just need to measure that against the potential environmental liability.
What about carbon credits? Are they an ideal mitigation mechanism, especially for essentially African coal miners?
Yes and no, because carbon credits, when I think of, for example, the Australian experience, well, it's been a mixed bag. But of course, if we have a framework in place that we can hold all parties accountable to, then of course that is obviously one way to go.
Let's focus on taxes, though, because this always tends to be a very contentious issue right across Africa. We've seen a push for beneficiation and tax incentives, or rather disincentives, to push that along as well. But let's start with Kenya. Capital gains tax, so looking at very high rates on farm-out deals. Is that an disincentive to invest in this country?
There's two ways to look at that. I suppose part of the thinking, one school of thought has it that, the higher the tax rate, then the more perhaps structured the investors will be, because what the government on one hand is trying to do is to avoid speculation on assets where capital is transferred outside our borders and the country doesn't see a benefit. Of course, the side effect of that is that it makes the layering of investment, which is how extractive industry typically works, where smaller players sell to bigger players. It makes that much harder. But once again, the silver lining in what could potentially be an investment cloud is that depending on your tax rate, obviously then you attract very, very serious players, because if it's not attractive to the smaller players, but you do have a high-grade deposit, then that potentially would be attractive to bigger players who can afford to come in and develop a resource right through production and not have to jump those hurdles.
So essentially, it's an economic argument. Higher
Yes.
taxes essentially keeping out all the speculative players,
Yes.
but also essentially not so high as to detract all the serious guys in the market.
Exactly.
Right. One last question for you, sir. A lot of African states have been pushing for the last couple of years for more value addition in their local economies, Zimbabwe being a case in point in this. But we've seen a pullback as well, because in Zimbabwe's case, they wanted chrome and, of course, platinum processed locally, but the infrastructure and the environment for that simply was not conducive, and they're not the only country to have done that. Are sub-Saharan countries essentially jumping the gun here?
We are, because there's an economic argument to be made, of course, that value addition would leave more money in country, and that's a fact. I think that's an indisputable fact. But the fact of the matter is that our infrastructure, in fact, even in South Africa, I know recently one of the big miners, either BHP or Rio, has shut down aluminum smelters in Mozambique and South Africa, and they're always looking at their options because they just can't get the power to run these smelters. Here in Kenya, if we were looking at, say, a comparable scenario, we're producing maybe 2,000 megawatts, peak output, and to run maybe one of those smelters could probably take up half of that output very easily. So it's a good idea in principle, but I think we need to walk before we can run.
Right, and a quick run through the markets here for you. Despite, of course, the dismal news coming out of South Africa and the jitters around the gold mining index, the JSE all shares still closed higher by 7/10. We'll keep tabs on the gold index specifically over this week. This, of course, is the first session of those talks between the gold miners and the unions. AMCU's coming out and they're making a very vociferous argument that actually they have a larger share of miners than what the Chamber of Mines says they actually do. According to Chamber of Mines statistics, it's 29%, with NAM at about 54. AMCU, however, says the numbers are very, very different. Coming up next, we will be in Nigeria. The central bank struggling to prop up the naira as it weakens against major global currencies. And we'll be looking at the demand for luxury cars in South Africa. And there's a hint of Clarkson, Hammond and May about this story coming up next. Africa is on the move. It's home to 7 of the world's 10 fastest growing economies. We help you make sense of the fast-changing African business landscape. We take you where the business is happening. Global Business, weekdays at this time on CCTV Africa. Welcome back to the program. Now, if climate change models are correct, many sub-Saharan African regional agricultural producers are under significant threat from changing long-term weather conditions. Now, agriculture employs roughly 65% of the population right across sub-Saharan Africa, and it accounts for about a third of the region's gross domestic product. So agriculture, as you can see from those numbers, plays an enormously important role in the continent's future economic growth. But with the World Bank predicting that warming of about 2 degrees Celsius, total crop yields across sub-Saharan Africa will drop by 10%, and that by the 2050s, greater warming will cause yields to decrease by up to 20%, the news and the prognosis is not pretty. However, before we get too despondent, many within the sector are confident that with the right approach, the right policies and the right tech, farmers should be able to adapt to these potential changes in conditions without any problems. Let's get some more details on this. Michael Marshall is a scientist at the Consultative Group for International Agricultural Research. He's with me in studio right now. Thank you for your time, Michael. Africa's population, by some estimates, will go up to about 2 billion in the next 4 decades. Now, if production methods and government policies remain the same between now and then, how will food production be affected?
Well, I think the most critical aspect to consider are smallholder farmers. These are farmers that don't have coping mechanisms to deal with climate change. And as you said, yes, global warming is going to have a significant impact on agriculture in Africa. And then if you think of other factors along with population, such as urbanization, increased mechanized agriculture, this is going to push a lot of these smallholder farmers into what we call climate fringe areas. These are areas that are very degraded and also suffer from extremes like floods and droughts. And so if climate does get more variable, more extreme in the future, these farmers are going to suffer the most. And that's where you're going to see the loss in production. And
we should also point out that the bulk of the food consumed on this continent is also produced by those exact same small-scale farmers, isn't it?
Yeah, that's true. The majority of livelihoods in sub-Saharan Africa are surrounded or involved in smallholder farming, also pastoralists, and almost all of them depend on rainfall to grow their crops, to water their livestock. So yes, it's very critical here.
Indeed. Let's focus on the move towards mechanization, because some have argued that African agriculture needs to adapt in part by moving up the value chain, becoming larger in scale, becoming more mechanized, but at the same time, water supply is becoming increasingly scarce, partly because of climate change. How do we adapt to that sort of scenario?
Right, and I think the real opportunity is with water security. As we just discussed, most farmers rely on rainfall to grow their crops, to water their livestock. And at the same time, recent studies have shown that large, perhaps untapped aquifers exist in many sort of climate fringe areas, food insecure countries, yet less than 4% of arable farmland in Africa is irrigated. So there is an opportunity, I think, for irrigation combined with other water harvesting technologies such as agroforestry. And when I say irrigation, I'm not talking about the sort of large government-sponsored expensive projects. These have been tried in sub-Saharan Africa, and many of them, most of them have failed. What I'm talking about is community-led, sort of grassroots, small-scale distributed irrigation. And we're seeing some very successful projects in West Africa with the regreening of the Sahel. And I think as people become more aware of these practices and technologies, that this will be the way forward to make Africa water secure and food secure.
Just to follow up on that particular problem, why is it that those large-scale irrigation projects that are usually state-funded fail? Is it because the community that's supposed to use these projects don't have any skin in the game?
That's definitely a factor. I mean, grassroots initiatives, what makes them attractive is that communities are usually involved in the decision-making process, and so there's buy-in. Whereas the sort of top-down, big-scale projects are done at the national level, and there's typically a disconnect from between the smallholder farmers and the government officials designing and executing the projects.
Indeed. Thank you for your time, Michael Marshall, scientist with the Consultative Group for International Agricultural Research. Unfortunately, that's all we have time for tonight. Fascinating talking to you all the same. Let's head over to Nigeria now. The country's embattled currency, the naira, has depreciated quite a bit as a net oil exporter is struggling to cope with a steep fall in oil prices. Now, despite efforts by the central bank to prop up the naira, the currency has depreciated even further against the dollar, the pound and the euro last week. Financial analyst Angus Campbell explains where the naira is headed.
Well, it's an interesting one because they sort of had this sort of quasi-peg against the US dollar around 199, and really it should be a lot lower than that, or at least the dollar to naira should be higher. And I think, you know, the reports are trading it on the black market around, you know, 220 or so, and various banks believe that it should be around 240 in value to the dollar. So I think against other currencies where it isn't sort of this quasi-peg doesn't exist, it obviously is just falling a little bit. So, you know, at the moment the central bank is trying to prevent further weakness against the dollar, but it's not really assisting. I think that they will gradually come round. You know, that there are obviously, you know, more sort of significant issues geopolitically, of course, in Nigeria. But in order to attract foreign investment further, they need to sort of slightly free float their currency a bit more. They need to remove these restrictions. You know, what Nigeria needs, I think, is a combination of higher oil prices. So it's very significant for the government. It's, you know, some 2/3 of revenue. So we need to see a recovery in the price of crude, but also we need to see a slightly more free-floating currency.
Slightly more free-floating indeed. Now, despite Nigerian authorities announcing that the country would beat the deadline to switch to digital broadcasting, the vast majority of the country's population still get their TV fix, a lack of power notwithstanding, through old-school analog transmissions. As Daji Badmus reports, broadcasting authorities there argued that a lack of funding is the root problem for the delay.
All the television signals that are currently available today, come June 17, 2015, they will go off. All the TV channels you see today will go off, and you will have to watch television. Either if you have an integrated TV set that can receive digital signals, or you have a set-top box that, you know, is able to decode the digital signal to your current analog TV.
That is the head of the body that regulates broadcasting in Nigeria, speaking late last year. But contrary to American Bar's warning, when June 17, 2015 arrived, Nigeria did not make the digital switch over. Broadcasting is still essentially analog in Africa's largest economy.
We've had challenge with funding, which has been a major issue, not just in Nigeria, but I guess now everybody knows most of the continent has had challenge with funding, especially for the converter boxes, for the set-top boxes. That has been a major challenge. We've gotten some level of approval from the federal government with regards to the funding. A budget has been approved, but we haven't been cashed back. We haven't received the money.
Without the needed funding for now, the National Broadcasting Commission, which is driving the process, has set its own deadline for the country, December 2017. It also says it is looking for alternative source of funding as well.
The journey has started for us in Nigeria. We have close to 22% digital penetration. That continues to grow. We have the most active, the most dynamic broadcasting market. We have very many television stations that are already digital. We just put out an expression of interest for new digital channels. We received over 100 submissions for new digital TV channels. We are hopeful that on or before December next year, we will be able to complete the process and be able to switch off analog signals.
Despite the country's failure to meet the June 17, 2015 deadline, television viewers are hardly complaining. Most people still do not even understand the whole talk about the digital switchover. They are simply content with the analog transmission they are getting at the moment. And one more thing, they're still buying analog TV sets. So even if the NBC missed the new deadline of December 2017, most television viewers here would simply not bother. Deji Badmo, CCTV, Lagos, Nigeria.
Now let's move on to South Africa. It's got one of the fastest growing and largest car markets in the world. In 2014, over 644,000 vehicles are sold there. Now that's slightly lower than 2013 sales figures due to a combination of factors, low economic growth and constrained consumer spending among them. But sales projections for 2015 are higher. Most South Africans, like elsewhere on the planet, buy cars to just get from point A to point B, their appliances. But many also buy luxury cars and sports cars. Sumitra Naidu attended the Clarkson, Hammond and May live show in Joburg to dive into South Africa's car culture.
TV shows about cars, whether they're being bought, sold or pimped, have become extremely popular. So much so that show hosts now travel the world to entertain their fans. Former Top Gear host Jeremy Clarkson and his co-presenters Richard Hammond and James May are back in South Africa for the 9th time. Fans wasted no time in getting in line to see them and all the action on the tracks.
Truly it was incredible. I enjoyed it a lot. They just all tricked out and looking good, sounding good. I just loved it. The cars are awesome.
They speed cars and drift, and I like the way they're so fast at driving. My favorite car is a Ferrari because it has a lot of horsepower.
There's probably more than 20 million rands worth of value just in cars here. In the actual show itself, we've got a sequence where we look at the history of Lamborghini. We start with the Moira, which is like a 13 million rand car, and we go all the way through until we get to the current one today. You know, so there's so much value. It's cars that really have so much history.
Breathtaking stunts and skilled handling, the torque, speed and sheer glamour of the cars left crowds gasping.
I thought it was really quite blurry because the cars were just going so fast, and then they were all different colors. It was awesome.
Fans were also treated to a special guest appearance by rally car driver and legendary drifter Ken Block.
I had to come see Ken Block's coming here with his unicorn, 660 horsepower with a 4-wheel drive Mustang 69, so I definitely had to come here, and it's an awesome show.
Well, as you can see, South Africans clearly love their cars. Over 40,000 tickets were sold for this weekend's car show, and it seems that Clarkson, Hammond and May are not the only attraction.
Dubbed the Orange Monster, the super-enhanced BMW M3 was one of several speed machines on display by RG Motorsport.
We've got our supercharged Toyota 86 in the show. It usually comes out normally aspirated with 147 kilowatts and 205 newton meters. We bolt on a supercharger, pushes up the power to 220 kilowatts and 350 newton meters.
And it seemed fans were uninterested in the controversy surrounding the former Top Gear trio's falling out with the BBC. Car enthusiasts were more enthralled by the long line of supercars on show and daredevil tricks. Sumitra Naidu, CCTV, Johannesburg.
I just turned into a 2-year-old watching that. Right then, moving on into commodity prices here fairly quickly. Egypt apparently has struck quite the deal with regard to LNG cargoes with BP, but for less than initially planned. The British firm will be providing about 16 cargoes of LNG to the Egyptian gas holding company. This, of course, was part of a deal worth about $2.2 billion initially tendered out in January in order to supply quite a bit of gas over to Egypt. 10 years on, a family business in Ethiopia is battling to stay afloat in the international shoe industry. Their stories coming up next. Welcome back to the program. You're still watching Global Business Africa. Now then, partly because it's home to some of the largest herds in Africa, Ethiopia does produce some fairly high quality leather goods, which are in demand internationally. Ethiopia's leather industry has experienced quite a bit of growth in recent years, with some local manufacturers and exporters now fearing they will struggle to compete as overseas companies set up shop in the country. Andrew Thompson has that story on Grassroots tonight.
This factory in Ethiopia's capital, Addis Ababa, produces shoes for the international export market, part of the nation's sizable leather manufacturing industry. Established over 10 years ago as a family business with little capital, the company now provides employment and training for over 120 workers, 80% of whom are women.
The job is good and I'm happy working here. Before I came here, I had no clue about shoemaking, but with the increasing demand, the company is now looking to scale up production.
With increasing demand, the company is looking to scale up production.
Right now, we're making about 160,000 shoes annually, but we can enlarge our annual production capacity to at least 380 or 420,000 shoes, or even 500,000 shoes if we had some machinery. Also, if we double or triple the shift, I hope our annual production will increase to 500,000 or 600,000 shoes.
Brand awareness for Ethiopia as a high-quality leather goods producer has been steadily growing amongst international markets. There are some fears that just as the Ethiopian brand has begun to be recognised, it could be diluted by the recent launch of a multi-billion-dollar Chinese leather processing centre in the country. It's a sentiment that the factory owners have dismissed, believing the local industry can coexist with the new international entrants.
Currently, the leather industry in Ethiopia is showing development and a transformation in technology and knowledge. In the future, it will become the hope for Africa, Europe and other countries in leather products. If we continue promoting ourselves very well, I hope we will become the leading shoemaking nation in Africa.
Jamaica Shoes is planning to collaborate with foreign shoe companies in a joint venture to grow its market base. However, the sector will have to overcome local barriers to growth. The World Bank says many firms within Ethiopia's private sector still face significant funding challenges, with financial institutions not fully accommodating their needs. However, the local sector is confident its high-quality leather products will see cash flows increase and industry growth continue. Andrew Thompson, CCTV.
Quick run through the currencies here for you. The Kenyan shilling does continue to weaken, 98.55, the relevant number we're looking at today. Over in South Africa, however, the Reserve Bank is flagging a rise in power prices as the most important threat to headline inflation. We'll see how that influences the rate of tightening and the pace at which that tightening takes place, of course, in the short run. But that's it for this edition of the program. As always, you can send your feedback, your ideas, your pictures, your feedback to globalbusinessafrica@cctv.com. Thank you for watching. We'll see you tomorrow right here in 23 hours.